Welcome back. Now, the National Bureau of Statistics yesterday released the inflation figure for April, and the headline inflation once again declined for the third consecutive month, albeit marginally by 0.02% to 17.24% in April. For most economies, this marginal decline in the inflationary rate highlights the fact that the effect of base year effects are waning. Let's talk more on Nigeria's economy with an economist and the CEO, the CFG Advisory, Tilewa Adebajo. Good morning. Thank you very much for joining us, Tilewa.
Good morning.
Now, when you saw the inflation number released by National Bureau of Statistics yesterday, what came to your mind?
Well, there's really nothing. It was quite expected because obviously there's marginal. But I think what is important is that if you take a look at the trend of inflation, you find out that it has actually bottomed out. And it might be gradual, but we're seeing a bottoming out and we're seeing a decline in headline numbers. But if you drill down further, the most disturbing aspect of inflation are the food prices. The food prices are actually going up. You're looking at it going up from about 18.4 to 19.3. So really, that's really where we have the problem, especially because food is a key security item that we need. Some people subject that to the fact that, well, the planting season is just starting, and we've used up the harvest from last year, and we're expecting new crop in this season, and hopefully by the time we have a new harvest, food prices should be able to come down. But we'll see. But those are the disturbing times. Well, obviously, we do not yet see a trend, a downward trend, to say we can be specific that to say inflation is definitely on the way down. But we know it has bottomed up.
Now, would you say that the central bank's intervention at the foreign exchange market has had much impact, or what you're seeing, the inflationary trend you're seeing, is expected considering the so much intervention by the central bank on the foreign exchange market?
Well, the intervention on the foreign exchange markets probably would be looking at the prices of inputs. The key pressure on the cost push inflation which we have, the inflation is cost push inflation, was driven by strictly fuel prices. And with increase in fuel prices means the increase in transports. And if you're transporting food products into the markets, they're going to be increased because you have increased transport costs. So really that has been the problem. And to see whether the economy has fully absorbed that price increase from the fuel prices. That is really where we are right now. The foreign exchange, as you say, the intervention itself would help lower the cost of factors of production of inputs, but we're yet to see that impact.
Right. You talked about the inflation, it's bottoming out, and of course from your graph also, the GDP, talking about the negative GDP growth rate also bottoming out. How? Could you explain this?
Well, I don't know if you're able to project the graphs, but what you find out is the fact that we're at a very critical stage whereby you can see from the graphs that inflation has really hit a peak, and you can see that it's bottomed out and it's coming down. On the other side, you can see that GDP growth, which has been negative, has bottomed out at about minus 2.24, and basically we're beginning to see the trajectory on an upward trend. So as you can see, these are what we'll say the germinating and the budding signs of a recovery. And it's important that policies are put in place so that we can sustain the downward trajectory on inflation and the upward trajectory on growth. So this is really where we're critical. So we're saying that we've reached the bottom for both inflation and growth. So the economic recovery growth plan that the government has put out, consistency in policy, harmonization of macroeconomic policy and fiscal policy, we'll begin to see a situation whereby we can have sustained growth. But it's still early stages. It's just germinating. They're buds.
Now, yesterday at a town hall meeting, the Minister of Finance actually said that Nigeria has come out of recession. Is Nigeria out of recession?
Well, as you can see from that graph, we're not yet out of the woods. And I think it's important that we understand that these are just budding signs of that growth. And by the time you've hit a bottom of minus 2.24, you can see, yes, we're coming out, but we're still in negative territory. And the population growth for Nigeria is about 2.5% per annum. So at the minimum, we need to first of all get back to zero. Then we need to grow at least more than 2.5% per annum for us to be able to ensure that our GDP growth exceeds our inflation growth for us to have meaningful growth. Yes, we're on the way there. Still early signs. It's germinating. It's in the budding stage. But we need to see sustained policies not to be able to kill that momentum.
All right. Now, the IMF was in Nigeria recently for their Article 4 consultation, and their review was quite mixed. Although they raised concerns about the FX regime. Now, looking at what the IMF is saying, how do you tie it up with the latest developments in the economy, talking about the PMI numbers that seem to be quite impressive, and of course the downward trajectory of the inflation rate?
Well, the Article 4 report was actually a very good report. It's a good independent review of where we are. And I think, yes, all the positive points, the consensus they had on the Economic Recovery Growth Plan. We've seen the Economic Recovery Growth Plan, and I think what is important is that we need to now put in place policies, as they have said, to be able to support the implementation of the Economic Recovery Growth Plan. That is really where we begin to see the action. So as you can see that we've bottomed out and we're in budding stages, it is the consistency of government policies that will now sustain the downward trend in inflation and the upward growth in GDP. And I think that is what is important. But the key problem, and I think the key point from the Article 4 consultation, is the fact that we still have a foreign exchange system that is not yet market-driven. We have a market-driven system, but the central bank is not allowing that to work because of multiple exchange system. The central bank really needs to have faith in that market-based system. And the danger point we have for us now is that, as the Article 4 report pointed out, is the fact that our interest service to revenue ratio has doubled now to 66%. So we're now using 66% of our revenue